Your CPA is great at filing taxes. Planning for taxes in retirement? Not so much. This episode exposes the gap and shows you how to fix it before the IRS comes knocking. Hello and welcome to Retire Stronger, episode 17. The podcast where we cut through the noise and bring you real, actionable insights to help you retire with confidence and clarity. I'm your host, John Foard, and today's episode is one that may surprise you, challenge your assumptions, and if you're like most high-income earners or retirees that we meet, open your eyes to something that's been hiding in plain sight. And as always, with me today is my co-host, Bill Kearney. Bill, say hello to everyone.
Hey, John, how you doing?
I'm doing great. Hope you had a good past couple of days since we last got on here to do a recording.
I did. I'm excited about the topic today here, John. It looks like from our notes that we've put together here, we're going to bash CPAs for about 30 minutes. Is that what we're doing?
Yeah, that's kind of funny. No, definitely not going to bash CPAs. I know you're just joking, but we are going to talk about today's topic, which is the truth about your CPA and tax planning for retirement. So I know you kind of obviously you're raring to go and you're ready to dive right into this topic. I know you wanted to talk about this first set of information we kind of put together in our show notes here. So why don't you kick it off with the CPA myth, what they do versus what you think they do?
Sure. And, full disclosure, totally joking. We love CPAs. We love accountants. They are absolutely essential for us to be successful in our practice. And we'll talk about why that is today as well. But just having a little industry fun here as we get started. I think we kind of have to address an elephant in the room, though, as we talk about this, John. I think that a lot of people assume if they're working with an accountant, in particular, a certified public accountant, right, the CPA, that your tax planning is covered. And I think this is a natural assumption. If you're working with someone like this, your CPA files your taxes every year. They give you advice if something seems off, and they might even be able to help you with business-related decisions. So that feels like we're getting tax planning advice there. But the truth is, and something that most professionals out there won't say out loud, is that most CPAs are not tax planners. They are tax preparers. And there is a distinct difference in those two categories. And the difference could potentially cost you a lot of money. You've got to think of it like this. Your CPA is essentially a historian. Their job is to look backward, to gather information, gather the documents from last year, plug in the numbers, and file your return according to the rules, according to the IRS's rules. What they don't typically do, unless they specialize in it, is looking forward. And that's where actual tax planning work begins, is by looking forward. Most CPAs are not actively helping you to reduce your future taxes. They're not analyzing how today's decisions are going to impact you in 10 or 20 years, especially in retirement. That kind of work falls into a completely different category, which we would categorize as proactive strategic tax planning. So that's the giant elephant in the room, right? We need to make sure that we understand what we're dealing with here. Are we dealing with someone who looks forward in addition to looking backward and preparing your taxes? We find that most times that's not the case. All right. So if that is true, and we're going to go ahead and say that it is for the most part here, John, how does that impact us for retirement? What are the implications here that we need to be aware of?
Yeah, so essentially why this matters for retirement. So why does this distinction matter so much? Basically, it's because your retirement isn't funded just by your savings. It's funded by what you get to keep after taxes. And the reality is that for many high-income professionals and retirees, the biggest tax bills are lurking in the future. For example, when your required minimum distributions are going to hit you, when Social Security becomes taxable, and when rising tax rates potentially erode more of your wealth than what you would expect. Like, here's a great example, Bill. Imagine you've done a great job of saving and you have $2 million dollars in your traditional IRA or 401k. That money is pre-tax, meaning you've not paid taxes on any of those dollars yet. And guess what though? The IRS is patiently waiting on you to turn 73, or in the future when the rules change to age 75. When you hit those numbers, you'll be forced to take money out whether you need the money or not. And that is again your required minimum distribution, or otherwise known as your RMD. And those distributions, well, they're taxed as ordinary income, possibly, and for a lot of our clients, pushing you into a higher tax bracket in retirement than you were during your working years. Here's the kicker: your CPA probably isn't warning you about this. Why? Because it's not happening this year. It's not on this year's return. It's not part of the historical snapshot that they're focused on. You said it earlier. Most CPAs are historians. They are not planning for the future. And so this is something that we constantly are reminding our clients to have discussions with their CPAs. Like you mentioned it before, we think CPAs do a great job, and we work with many CPAs, together in helping our clients with these issues that we're talking about right now. But you could be heading toward a tax bomb in retirement without even realizing it. So, I know we wanted to talk next a little bit about, what we can do proactively to help this situation or to head this off at the pass. So I know you were pretty passionate about this piece, so I'll let you kind of dive in here.
Yeah, and John, I want to back up for just a minute and say too that ultimately we live in what I like to call a microwave popcorn society, right? Um, we everything has to be determined immediately, right now, and what is happening right now today is what's the most important thing. That's kind of what the mindset is as it relates to tax preparation as well. And what I mean by that is, oftentimes the success of a CPA is determined by how much they save you in taxes. Now,
Correct.
that's not a label that the CPA has put on themselves. That's a label that the consumer has put on that industry. It's not your CPA's fault, but they oftentimes fall into this because people may hire or fire based on a reputation of what they can save you in taxes and what it costs them to do the work. Uh,
Mhm.
Ultimately, that's not fair to your CPA, and it's really not going to provide you probably with the best long-term tax planning at all. That's kind of what that industry has been handcuffed with, and I don't think it's a fair way to look at it, because ultimately, what you're doing today is going to have an impact on the future. Now, can we balance these two things? Absolutely, we can balance getting success today in the tax world with what it's going to look like in the future and how it's going to help you. So, what does that mean? What is proactive tax planning? What does it look like? Well, we've cleared the air on this, and we've kind of beat up on the industry a little bit here. Let's talk about what real tax planning looks like. We've kind of alluded to this here. Real tax planning is forward looking. It's
Mhm.
about identifying opportunities now to reduce taxes later. It's about leveraging things like Roth conversions, which we've now done 19 out of 18 podcasts on Roth conversions. Um, it's it's about managing your tax brackets intentionally year by year, right? That goes back into filling up tax bracket buckets as it relates to Roth conversions. Um, Coordinating your Social Security timing with your withdrawal strategy, creating a tax efficient plan for your heirs. There is so much that goes into this. This is why ultimately the way we look at it as financial planners, tax planning is a lifelong process because the rules are constantly changing and the dynamics of your life are constantly changing. The events on the ground are constantly changing. So every year, at least once a year, this has to be revisited to make sure you're in the most optimal format. And sometimes there can be a natural tug against what the CPA is telling you to do in a given calendar year. That's why our view is you really want to have a team of experts who are all on the same page about what your goals and your plans are for the future. Because if everybody's on the same page and singing from the same sheet of music, then we can work together and help you move forward. But if none of these people ever talk to each other, if your CPA doesn't talk to your financial planner, right? If your estate planner doesn't talk to your if everyone's kind of doing their own thing, that's when we start to see fractures in the success of the plan overall. So I'm going to give you a quick real world strategy. Okay. So let's say that you've done great in working, you're ready to retire, you're 62 years old, and you decide to delay Social Security until age 70. So between 62 and 70, your income might be much lower than it was before. Maybe low enough to convert some of those pre-tax dollars that John was talking about into a Roth. All right. And again, listen to any one of our 28 previous podcasts on Roth conversions, and you'll be able to find out more about that. Right. And we joke about this, but we talk about Roth conversions so much because they're so important. They're
Yep.
critical as part of your tax planning, right? This really is the tax planning sweet spot. That age 62 to 70 really could be a sweet spot for you as far as realigning your plan to optimize your tax picture. But if no
Hmm.
one is helping you spot this opportunity, then it's going to pass you by, right? And you
Hmm.
can't go back and redo it again. So, ultimately, there's a pretty good chance that your CPA is not running these types of projections for you. They're focused on compliance, not on long term reduction of tax liability. And this is where working with a financial planner who specializes in tax planning, especially someone who collaborates with CPAs but doesn't delegate all of their responsibilities to them, can make a huge difference. So, let's talk a little bit more about incentives and capacity and all of that. Let's be a little fair to the CPAs here, John.
Hmm.
Where do they come in this equation?
So, it's a great question. So, why don't most CPAs offer this kind of planning? I would say it's two big reasons. You mentioned it: incentives and capacity. First, on the incentives side of things, CPAs are typically paid to prepare tax returns, not to analyze long-term tax strategy, which you've already mentioned. I think we've beat that into the ground at this point. But there's no financial upside for them to spend hours building a future-looking retirement tax model unless they charge for it, which most don't. Um, and not only that, but we just talked about a minute ago about forward looking and forward planning to maximize your tax brackets every year and to plan for how that will look and how that will play out. Sometimes that might mean doing things like, again, we're going to mention this again, Roth conversions, which will cost you additional monies in taxes if you just left the money in a traditional IRA. CPAs are judged. We've already said this again, and I'll say it again. They're judged on how much they save you in tax dollars every year. If they come to you and tell you to pay more in taxes and take a larger hit on your tax bill for the year, most clients are not going to want to do that. Most of their people that they work with are going to be like, "What are you talking about? Why in the world would I want to cost myself even more in taxes each year?" So that's kind of goes along with the incentive piece of it, right? They're not incentivized to try and convince you to spend more in taxes and have a larger tax bill. Second would be, again, I mentioned a second ago, the two things here, incentives and capacity. So the second thing is capacity. The average CPA handles hundreds of clients, especially during tax season. They're buried in forms, deadlines, and compliance work. Their bandwidth just isn't there for long range thinking. Even if they wanted to offer it, they just don't have the capacity to do it. And folks, I want to be very clear. I know, Bill, you were joking earlier, and we've talked a lot about this, but this isn't about incompetence. This isn't about a CPA not knowing what to do or how to do it. It's about scope, and it's up to you to know the difference. And so that's why we wanted to talk through this today with everyone and kind of expose that gap, as we mentioned, and help you figure out ways to plan for it and fill that void to make a more tax efficient plan going forward. So, all right, Bill, what can we do about this?
Yeah, there's one other little area we need to swerve the car over into the parking area here and sit for just a minute, which is related to CPAs who actually do provide financial planning advice. And
Hmm.
many people may not be aware, but CPAs, through their licensing, oftentimes are able to provide you with financial products. But there are a few things you might want to think about here related to CPA and financial planning combinations. Um, First of all, I think you've got to think about the breadth of financial planning. We just mentioned earlier all of these things between ages 62 and 70, just that 8 years that you really need to think about, and the complex planning that goes into those years. And I think that in my experience, John, you could probably agree with this, is that we've found CPAs who might say dabble in financial planning, but don't go into deep areas like risk management or asset allocation, or even coordinate with others in estate planning, things like that, right? And you
I
just
agree.
mentioned, you just mentioned that CPAs are working with hundreds of clients, and so they may run into an issue of limited time and bandwidth to deal with your financial plan, especially during tax season, which now tax season seems like it's most of the year. It used to be April 15th was tax day, but now it just seems like it's easy to file extensions. People are dragging this out and later into the year. CPAs are often very overloaded and maybe too overloaded to offer proactive planning. So I think that in those instances, financial planning might be treated as a side service rather than a primary focus. This is why the philosophy that we have always carried, that I mentioned earlier, is it's not possible for one person to do everything. Most of the times we're limited by licensing, right?
Hmm.
We can't file taxes if we're not a CPA. I mean, we can help with those things, but that's not our specialty. We want to work with people who that's their specialty. Um, so, with all of that being said, I think we need some action steps here, right? If you want to get serious about tax efficient retirement planning, you've got to ask the right questions. So, don't ask your CPA something like, "Do I owe anything this year?" Right? Maybe you want to ask them, "How can I reduce my lifetime tax bill starting now?" Or have you been able to calculate, or are you able to calculate what my lifetime cumulative tax picture looks like based on the path that I'm on now, right? From there, maybe you need to look at finding a professional who specializes in tax planning. This might be a certified financial planner. Um, lo and behold, we happen to have one on staff in our firm. He happens to be on this podcast right now, ironically. Uh, an advisor with a tax focused process, um, or even a CPA who does offer forward looking services, and you've identified that they could meet those forward looking needs that you're going to have. And you want to start early. The best tax planning happens before you retire. If you wait until your RMDs kick in your 70s, or until you're deep in retirement, your flexibility is limited here. And so ultimately, what we're saying is you need to get a tax map. Some financial planners create what's called a tax map. This can be called all sorts of different things, but it would be a multi-year strategy showing when and how to shift assets, take income, minimize taxes over your lifetime, and on and on. And it can be as detailed as you want from there. And we'll go back to this maybe for the third or fourth time. You need to have folks who are helping coordinate all of the moving parts. We need these people to work together to really be effective in your plan. We want the plan to work together. We don't want pieces pulling apart. So your investments, your income, your withdrawals, your estate plan, they all interact with the tax code. So planning in silos just doesn't work anymore. We can't do it that way. It's too complex. There's a reason there's 77,000 pages in the IRS tax code, right? It's complicated. It's complex. And different parts and pieces are going to interact with you and your finances. So it would be ideal to have someone or a group of people who are helping to quarterback that relationship.
Absolutely. Absolutely. So, I feel like we've hit all the major thoughts we wanted to discuss with everyone today. So why don't we wrap it up here, and I'll kind of give some closing thoughts, and if you have anything you want to add, would love to hear it, Bill. But folks, we'll leave you with this: the tax code is full of opportunities for people and individuals who plan ahead, and it's full of missed opportunities for those who don't. Um, don't mistake tax filing for tax planning. Don't assume that your CPA is watching out for future tax threats, and don't wait until it's too late to act. If you've saved diligently for retirement, it's time to protect what you've built by making taxes work for you, not against you. And remember, folks, we're a financial planning firm. If you're over the age of 40, you've saved diligently and accumulated a lot of retirement funds. Now it's time to protect it from taxes. Give us a call at 704-469-0200 to schedule a complimentary assessment, or go to our website at crownadvisorgroup.com. That's Crown Advisor with an OR group.com, and click the complimentary assessment button to schedule some time with us today. And again, I want to thank everybody for joining us. If this episode resonated with you, please share it with a friend, a colleague, a family member, and we appreciate you listening to all of our podcasts. Bill, anything you want to add to this?
I think just what we said earlier, do not mistake tax filing for tax planning. If that's what you've done previously, if you feel like, well, my taxes are filed every year, so I'm getting the tax planning that I need, you're likely not. So it's a good idea to maybe stop, take 5 yards, punt the football, evaluate the situation on the ground, and go from there. This is potentially too costly of an area to not have certainty in. And wish you well in your endeavors in doing that. And thanks everybody, of course, for listening this week again.
Absolutely. All right, folks. Until next time, I'm John Foard, and I'm with my co-host Bill Kearney, helping you retire stronger, one decision at a time. Thanks, everybody. Have a great week.